Okay, let's have another look at gold and silver. We saw signs of them regaining a bit of momentum today, but there was a brutal sell-off at the end of last week, and both are well below the record highs they hit. Let's get more from Jake Hanley, Chief Growth Officer and Director of Investments at Teucrium. Thanks very much indeed for joining us.
Thanks for having me, Andy.
And just to clear the decks, Teucrium, of course, you're known for copper, your copper ETF and other commodity-based ETFs, but you haven't got a gold and silver one yet.
No, that's true. And actually, we don't have a copper ETF.
Oh, I'm sorry.
No, that's quite all right. Well, I'm pretty bullish on copper, so I can understand the confusion. We are primarily in agriculture.
Oh, okay, sorry.
Corn, wheat, soybeans, and sugar. Yeah, but with copper, we do publish a commodities model portfolio, an allocation that we make available for anyone who'd like to receive an email from us, and we include the metals. And so we've been following these markets very closely.
Sorry, yeah, of course, you're known for Teucrium soybean fund, corn fund, sugar fund. You got the agricultural fund, and for some reason I thought you had a copper one. In any case, what have we learned about the gold and silver market over the past few weeks?
Oh, boy. Well, for anybody who was just getting involved in watching in the last few weeks, you've gone a crash course in speculation and volatility. I think what we've clearly seen with silver in particular is the crowd getting ahead of itself here. Prices got well ahead of fundamentals. And when you see a run up like that, there's this old saying that prices will continue to move higher until they don't. And boy, oh boy, when they stop, they can reverse quickly. And so the sell-off that we saw, some want to give it an adjective and say it was disorderly. I would say while the magnitude, it was a big sell-off, it was relatively orderly. And I say that because behind the scenes, you have a lot of structural risk programs that certainly were firing off to help institutional traders cover their positions to avoid what could have been contagion. And so while the sell-off was really big in silver, I think it was orderly. And I would just point to the fact that this really has been just for silver and gold markets, really hasn't bled over into equities, a little bit into copper. But because this was such a big sell-off, I was encouraged that the selling didn't bleed into broader markets.
Wall Street Journal highlights that it's relatively easy for retail investors to speculate in gold and silver, for example, using ETFs. We saw leveraged gold and silver ETFs, such as UGL and AGQ, posting massive turnover, and then they plunged by 60% in one case on Friday.
Yeah. And so, investors beware, make sure you understand the risks inherent, particularly with these leveraged products. A lot of them will track the daily performance and not a longer period. And so unless you're day trading those products, your experience will likely be worse than what you would think. I will just note, I've been looking at the flows, and I heard the last segment you were talking about ETF flows. Interestingly enough, it appears that the silver, 2X silver ETF, had a record trading volume on Friday during that sell-off, and it looks like it was buying because the fund took more inflows on yesterday, as it looks from the tape.
The narrative, you touched on this. I mean, it seems to be that speculators drove gold and silver. Obviously, it was a big part of it. The Wall Street Journal, again, argues that these things these days change quickly and investors jump onto the next shiny object.
Yeah, they do. But I would just put out there as well that there is a fundamental case for silver. There's a fundamental case for gold. There's a fundamental case for copper. And while the speculators certainly have the ability to add volatility that we've seen recently, the fundamental case is there. And I think it would be a mistake to ignore some of the longer term trends that we see developing in these markets. Again, if you're a day trader, if you're a speculator, if you're just following the momentum and following the trend, you're going to be in and out, and that's going to create volatility. But I do believe that when you zoom out and you look at a monthly chart, or if you just sit back and you're following along with what the fundamental supply-demand dynamics are in these markets, it's hard not to be bullish longer term. Now, there is certainly a bear case. They say that the trigger that set off the selling was the announcement of Kevin Warsh as the potential Fed chair. And so in my view, that's to be determined whether Mr. Warsh has what type of impact he has on gold and silver markets. But there's also global GDP growth. If we see a slowdown in growth, that could act as a weight on markets because inflation expectations would go down. Copper demand would potentially go down. The AI bubble could pop, right? If the AI bubble pops, then maybe there's not as much copper demand. So there's certainly risks. But again, if your base case is for global GDP to keep chugging around maybe that 3% level, and for the idea that the geopolitical situation does not seem to be improving in a positive way, I think things like copper and things like gold should continue to do well.
The old cliche, of course, is that an ounce of gold buys you a decent man's suit. So I'm trying to think, $5,000 US, that's a pretty good suit. I don't know, I'd call that pretty flashy. I mean, if you work at Goldman Sachs, maybe it's not fancy enough.
Yeah, well, to that point, you look very dapper, sir. And I go to the quarter zip sweaters these days because I don't have the 5,000 for a suit.
Yeah, oh no, you'll see me at the bargain rack. I ain't going there either. Thanks very much, Jake. I really appreciate it. Jake Hanley, Chief Growth Officer and Director of Investments at Teucrium.